to share your screen before the recording, suppose.
Okay, we're started now. All right. Well, Marty, thanks for being here. And I noticed you had a question about actually doing and completing equity analysis guide. So I'll just take it away. Ask your question.
Okay, Mark. Thank you very much for doing this. I appreciate it. Question was, how do you go about filling in the data and saving it to where it would change automatically, like I'm used to? And where do you go to get all of the data? So I guess that's kind of a couple of little questions there, Mark.
Okay.
Take it away.
Well, not a problem. I think what you're probably running into, Marty, is it's a preference setting within Excel. So let's take just a time out and do a quick Excel tutorial here. I always save my spreadsheets with the calculation set to recalc. And let me show you where you do that on an Excel spreadsheet. You actually use the Tools pull down and the Options tab, and you can see there's a variety of setting choices here, but under Calculation you have the option as a user to set your preference at either calculate automatically after every number that I enter, or only calculate when I tell you to do so. And you do that within Excel by actually striking the F9 key. And you can see that it does a recalculate before save. So I think that's probably what solved your mystery on the way. You saved it and came back. Because you had some blank fields, right? And
right.
They
wouldn't fill in, and I was expecting them to. So now
okay.
I can see why. Appreciate that.
Let me, many people will want to switch it to automatic, so I'm going to go ahead and do that. And
okay.
it really comes into play when we're taking a look at what we call a sensitivity analysis, where if you change one of the variables in one of the assumptions that you make, let's go ahead and say, what if we assumed a PE of 14 for Johnson & Johnson? When I hit enter, it'll actually change anything that's affected by that. And watch the projected annual return that's currently at par. I'm hitting enter right now. And you can see it changed the calculation for the annualized price appreciation and therefore the projected annual return. So we can just leave it that way for now. But again, just to review, if you want to change those settings, Tools, Options, under the Calculation tab, you can set it to either do it automatically or do it manually. In fact, I'm going to switch mine back to manually for the rest of the session just to demonstrate that. And now you'll see if I switch this back to 15 now and I press enter, it doesn't change everything. I actually have to hit F9. I'm doing that now. It'll put us back to 13.
Okay, I understand.
Again, and just as an editorial comment, we work with very large spreadsheets at Manifest, and simply we can't recalculate after every single number entry, so that's where that comes from.
Okay,
let's go ahead. You wanted to use Coca-Cola as the company to demonstrate?
Yes.
All right. Well, what I basically do, and this is up to any of you Excel users, you can do what you want to out there, but what I will do is grab an existing equity analysis guide from Manifest Investing, and then I literally just overwrite, filling in the yellow fields for the company. And you can see I have Johnson & Johnson displayed here, so let me demonstrate where you would go to get that. And what I'm going to do is go to the Manifest forum, and I want to show just a couple of things. First of all, like we like to reinforce in these type of sessions, in the Getting Started section, there's an obscure place called the glossary. And if you ever run into a situation where you're trying to figure out what in the world are we talking about, we call things rhinos, or as you said, Marty, the eagle, what in the world is an eagle? Go to the glossary. And in this case, you see that eagle is defined here. And hence you see the acronym for eagle. And then we also give, very often we'll give links to check out either the background on the situation or an article that describes it or whatever, another reference that explains it. And in this case, it's actually taken us into the forum, and I'll show a different way to get there, but you can see that the Excel spreadsheet is attached right here, and here's actually a closer look at the image, a snapshot of it right now also. The other way that you can get to that is by going into the Manifest Investing forum. Again, go to the forum, go into the Stocks folder, And what I'm going to begin doing going forward is anytime that there is an equity analysis guide attached to included in the analysis or the commentary, we'll go ahead and put the eagle tag up front. So in this case, we're going in, and again, we see that page that we just did. The equity analysis guide is right here. So what I'm going to go ahead and do is, if you clicked on that, you literally would pull up this spreadsheet. Okay, does that help a little bit, Marty?
Yes, it does, definitely.
So now let's convert it to Coca-Cola.
All right.
All I literally do is enter the company name, ticker. Then what I like to do is, before I get started, go ahead and check the analyst consensus forecast down here in our forecast audit to kind of give us some guidelines or something to shoot for. And the way that we do that is we slip over to the analyst estimates over at Yahoo Finance for Coca-Cola. Now, what do you suppose the odds are that they would be working on Coca-Cola's analyst estimates and we would get NA here? I mean, I do millions of these things, and this only happens. It rarely happens.
1 in a million.
1 in a million. But here you go. We're trying to do this, so this is going to happen to us. The workaround for this, well, first of all, the revenue estimates are still here. If you want to enter those into a stock selection guide analysis of the company, and we do encourage that. Embed those estimates and take a look at the impact on the long-term trend. The fact that these are NA is making life just a little bit more difficult for us, but if you page down, just scroll down the page a little bit, you can actually look and see that 7 days ago, there obviously, one of the analysts that turns in estimates for Coca-Cola is obviously working on it this morning. But 7 days ago, we had an estimate for the year ending December 31st, 2011 of 374, and that's what we would use, 374 on December 11th. And then we come down and grab the EPS growth rate. That's per year for the next 5 years. That's 8.5. So I'm going to jump back and make those entries first, just so I don't forget them. That was 374 at 8.5. And now I'm hitting my recalc button. The analyst consensus out there is for an earnings, a 5-year earnings forecast, out in August 2015 of about $5. So that's kind of the end. We're shooting for a comparison to that number when we complete our guide. All right, so I'm going to jump back to let's go ahead and just kind of take the tour. And what I always do is I start down here on the lower left-hand side. And again, just as a quick reminder to everybody, the income statement on the left-hand side is a snapshot of present-day conditions at Coca-Cola. So we're going to go grab the present-day numbers. And what I literally do is I work myself all the way around from one side to the other, starting at the stock price. So let's go ahead and take a sneak peek at what is the stock price right now. I see 55.45 for Coca-Cola. So come back. We'll make this 55.45. The second number that we need is an earnings per share estimate. And what I'm going to do for the balance of this is I'm going to slip over to Value Line. And all I'm going to now is the public version of Value Line, the free part of it at valueline.com. And what I'm going to do is go into the free reports for the Dow 30. Coca-Cola's in the Dow 30. And then I'm going to go down, and for what we're doing here, Marty, I just wanted to have Coca-Cola available right here. So we'll pull up that PDF for Coca-Cola. Now I suppose Value Line's working on it, and we're probably going to get bombed here. Good grief.
Yeah, there it comes.
It's trying. Go ahead and shut off my email so we don't have to contend with that anymore. Here's the most recent Value Line. You can see it's dated July 30th, so it's pretty current. And what we're going to use for our earnings estimate is to take a look and add up the four most recent quarters. And what I like to do is just think about, we're near the end of August. That means we're closest to the end of the September quarter. So what I would use is the 90 cents and then the 3 preceding quarters. And if you add those up on a calculator, you'll get $3.27. Okay, so we'll jump back here and we'll throw in our $3.27. And now what I'm going to do is hit F9, and that gives us a current PE ratio of approximately 17 for Coca-Cola. Now we need a share count. Again, jumping back to the value line page, going up to the capital structure box, we see they've got 2.307 billion shares outstanding. We look for this number in millions, so we're going to truncate it and just use the 2307. So 2307, that's the number of shares outstanding at Coca-Cola. Now what we need is the trailing 12 month of sales. And we'll do the same thing that we just did for earnings. What we really want here is, we have to jump back down the page here a little bit. What we really want is these 3 quarters in combination with this one also. And again,
the same as the areas you wrote before.
Right. So those 3 quarters, focusing in on the fact that, hey, we're near the end of August. Some of you probably break out in the hives saying, well, Mark, that's an estimate, that's a forecast. But I'll tell you what, if you go back and compare how much different this will be when they enter their actual number, it will not make a difference in the calculation we're doing.
It could be a little less, it could be a little more.
Yeah, doesn't matter.
Unlikely to be a lot less or a lot more.
Yeah, especially for a company like this.
Yeah.
So what I do is I just take and add those 4 up, and it's going to be 32,375. And just a quick mathematical shorthand here. I'm adding the 4 quarters together, but I do it just by taking a look at the difference in that last quarter. But again, just add the 4 up. And what you get is, when you add them up on your calculator, you should get 32,169. I can go ahead and get rid of that 0 because it just annoys me. And so we're talking about a $32 billion company right now. So now we're in position. If we hit our F9 again, so we have, this column is basically done. We have a $55 stock price, a PE of 17. We calculate a current net margin. That's our profitability measure of 23.5. And we have a trailing 12-month sales estimate. So now we need to build an annual rate forecast. Now you can do this one of 2 ways. If you're a mathematician or you're used to working with this kind of stuff, just use the formula that is shown up here. That's the future value, present value, end thing. Or you can pull out your financial calculator and do this. We're going to look for the answer to the question, what is Value Line using for their sales growth forecast? Keeping in mind that this number down here, you can use it. You could just go ahead and use the 5.5 right now, and we might play with that with the sensitivity analysis. Got a fussy mouse this morning. This 5.5 right here. Could use that. Keep in mind that is sales per share, which is okay. Just keep in mind that that's what we're using. But also keep in mind that for a company that has a lot of acquisitions and divestitures, the track record can be really messed up here, and you can get into some real quandaries. What I always do is I go up and I take a look at the revenue line up here. And what we're going to be doing is using 42,275 as our future value. 42,275, that's literally 4 years out. And comparing the growth rate, calculating the growth rate to today's 32,375. Okay, so with a financial calculator, the present value would be this 32,375. The future value would be this 42,275, and n would equal 4. So I'm going to jump back over here. I don't have a financial calculator at my fingertips, so I'm actually going to do the math. Now close your eyes if this is ugly for you. Future value divided by, and I'm not talking to you, Marty. I know you can handle it. Future viewers of this. We actually end up with the growth rate of 6.9% is what Value Line is assuming for top line growth at Coca-Cola. So that delivers a 5-year sales forecast. Again, I just hit F9 of, let's call it 45 billion. 45 billion.
Okay.
All right, so now, again, on my first pass, the first take a look at this analysis, I'm going to go ahead and grab the projected net margin from the Value Line page of 24.6. I obviously look at that with my right eyeball, and with my left eyeball, I'm looking back over here to see, how does that compare? We see that that's an all-time high, so that makes me a little nervous. But for our first pass through this, let's go ahead and use 24.6. Okay, now we need a share estimate.
Right.
What I use for the share estimate is you can go two ways with this. The simple approach is use the 2285. Take the 2285. The little more, perhaps a little more scientific approach, and it is the answer to what number is Value Line actually using. You take the net profit in their long-term forecast here, this 10,400, and divide it by their long-term earnings forecast. So 10,400 divided by 450. Let's see what that gives us. 10,400 divided by their long-term earnings forecast gives us a share count, which again is roughly the same as what it is today.
Pretty close, yes.
Pretty close. That kind of surprises me. I would have expected that to be a little bit lower. Like I said, you could use the 2285. In fact, I'll just mark that down over here. We might try that. Okay. That's a note for later. We might come back.
Or what if?
You know, and then for the sales, we had a 5.5. We might do a what if with that later also.
Okay.
For the sales. So those are just two numbers. You know, how much of a difference do they make? We hit F9 again, and we now have a 5-year earnings per share estimate based on our first two major assumptions of 6.9 and 24.6. And sneaking a peek down below, the analysts that follow the company are at $5.04. That's actually a relatively small difference. And I love to be -5 to -10 under the analysts. Just that's based on scads of empirical studies of how optimistic they can be. This is saying they are 5% more optimistic than us with respect to the long-term earnings forecast. I love to be in that range. All right, for a projected PE ratio for this cut, we would just go here and grab this 21. 21 for the long-term forecast. We'll throw it in.
And that's an, okay, I see it says projected average. I was going to say, is that average? Yes, it's an average.
Projected average
highs
PE,
and lows.
Right. And let's talk about that for a second, because I know we have a lot of NEIC people that are curious about that. That literally should resemble the average of your 4A and 4B PEs on your PE forecasts in Section 4 of a stock selection guide.
Okay, yes.
And in fact, what I've done for years when I'm setting those numbers is I'll take a look at this number. For a fairly steady company like Coca-Cola, I would probably divide that by something like 4. Now, if we divide 21 by 4, you get roughly 5. So I would be, if I'm completing the zoning on a stock selection guide, I would go 21 plus 5, 21 minus 5, and I would think about those two numbers shown here as my high and low PEs in Section 4A and 4B of a stock selection guide. So again, take the number, divide it by, again, a smaller number for the, or a larger number for the steadier companies like Coca-Cola. Sometimes I divide it by 3. You know, if I divided that by 3, we'd get 7, and then my numbers would be 28 and 14 over here. But for Coca-Cola, see how 26 and 16 fits on your stock selection guide. But for what we do here, we just need the average of the two, the projected average PE.
Right.
So by picking that PE, we have our 5-year earnings forecast. Multiplying the two together, we have a 5-year average stock price of $100. Again, that's calculating that out, and that's also giving us the calculation where what is the annualized price appreciation to go from 55 today to 100 5 years from now. It's 12.6% per year. For payout ratio, again, this one you can kind of rough in, but if you go down to the bottom of the value line sheet, you see this column here. It's usually the very last one on a value line sheet, all dividends to net profits. That's another way of saying payout ratio. And just eyeballing it, I'd say 50 is a pretty good number. Could say 49, but I think 50 is it. The payout ratio is 50 at Coca-Cola. So entering 50, that will give us our projected dividend yield, and we end up with a projected annual return of 15%. That's where the numbers come from, Marty.
That's great.
So now
that sure lightens it up. You know, lightens up the thought process, and puts in some good information.
And now what I would do is, as you see us do all the time on the forum, is actually dig in and take a look at what we looked at for, in this case it will be Johnson & Johnson numbers, but go and take a look at whatever information you can get your hands on with respect to profitability or PE ratios or whatever. Do a stock selection guide. Use this, do a stock selection guide and see what type of annual growth rate number you end up with for Coca-Cola. And the same thing is true for the profitability and the valuation. Use your stock selection guide to audit it. Sometimes I'll do the stock selection guide first so that I have these numbers in mind, again, those 3 core assumptions, before using the equity analysis guide. What I really like about the equity analysis guide is, just as we mentioned, now we can go in and say, well, what if it is only 5.5? Using that long-term forecast from Value Line, let's put in 5.5. And again, I'm hitting F9. How much does that drop our 15? Drops it down to 13.5. So again, a little more. Go ahead.
You could also probably look at the front side of your SSG and outline the first 5 years, if you so wished, and looked at the historical rate that it's been there, and use that if you like, I guess, couldn't you?
Absolutely. So I'm going to undo that, put it back to what it was, hit F9. And again, we could experiment. How big of a difference, and this will be the answer to the question, how much do we really need to worry about that share outstanding, at least for this company? Let's put in the 2285 that Value Line had. And again, you're not going to see much of a difference.
No.
15.2, so again, I wouldn't worry too much about it.
No. It was pretty close to begin with. But,
yeah. With other companies, it becomes a factor. Okay. And the last thing we should talk about is down here on the lower left. We have added this because of requests from our community of subscribers. We don't do zoning at Manifest, and you can study the forum for more information on that. But what we do believe in is buy and sell prices, buy below price and sell above price, that are based on the projected annual return, consistent with how we do everything else. Let's talk about first the answer to the question, at what price might we think about selling Coca-Cola? And for, I don't know, Marty, would you consider Coca-Cola to be a core or a non-core stock?
Oh, I would think it would be a core stock company. I mean, as large as it is, as long as they've been around, that certainly should be core, I would think. A steady grower.
Yep, and the answer to the question is it's in the eye of the beholder, of course. I suppose if you asked a Pepsi addict, they would answer it differently. I don't know. But let's assume that we're thinking, you and I agree on this, Marty. I think core makes sense. We talk about selling core holdings when their projected return approaches money market rates, which are right now down around 1%. In fact, I'll go ahead and put in 1% and hit F9. And that basically says that I would not be thinking about selling Coca-Cola if I held it. And I was doing an analysis update. I wouldn't be thinking about selling until about 104. We're a far cry from that. Okay, and on the other side of that, right now, my par is at about 15. Even for a core holding, I would probably want to see a minimum of about a 16% projected return right now. So let's see what the buy price for Coca-Cola is. Hitting F9, we're very close to the buy price. I mean, 16 is pretty ambitious. I know some people that would say, Mark, 12.5 is good enough for me. That's a couple percent better than the market right now. I'd be willing to buy Coca-Cola up to 61. So you can play your own what ifs with this. I'll leave it for now at 16, and we'll say.
And those two percentages or that percentage especially, takes into consideration the dividend yield.
Yes, it all does. Yep.
Right, which the SSG does not in that area, if I'm not mistaken.
That's correct. We talked about it last night. So it's something for everybody out there to chew on. So again, hopefully that helps a little bit. Again, I like to grab an existing stock selection, or excuse me, an existing equity analysis guide from our forum, match it up with the quarterly sequence at whatever company you're studying, and then just overwrite the numbers in the manner shown. So hopefully that helps you with what you were struggling with. And
it definitely does. One more thing. Could you show me in Toolkit on an SSG how you get that net margin chart.
Sure. This is the extra credit portion of this.
Okay.
Let's go ahead and do it, though. All right, I'm going to have to go down.
I didn't think this would take too awful long.
No, it shouldn't. It shouldn't. I'm going to actually open up my toolkit, and I still have toolkit 5. Don't yell at me. Don't hate me.
Okay.
They all work. It doesn't matter what you've got. So what we're going to do now, hopefully my internet connection's okay.
Oh.
All right. And what I will do now is enter Coca-Cola. Go grab it. Let's see if I've got one in the folder first. No, this is a brand new fresh one. So this is what you would pull. I'm pulling from the NEIC online stock data. You can see it's populating the sales and earnings and pre-tax profit fields for me. If we sneak a peek at the data, it's all there also. So we're ready to go, and we can demonstrate what Marty is asking about. Well, first of all, let's just kind of take a look. Those of you that have followed the stuff that I've done over the years know that I throw that one away. And then what I'll typically do is line up the sales. What I'm going to do is look for a little bit better point for the sales. This is 20, so let's just go up here and get it out of the way a little bit so we can see definitely that those two lines are pretty parallel, and it's a pretty steady situation there at Coca-Cola. So what I would do first for the guide, in fact, let's go through and demonstrate the concept of embedding those forward-looking estimates from the analysts also, Marty.
Okay.
So what I would do is I go into the data, and because what we're going to do, this is again using a screwdriver as a hammer, or a hammer as a screwdriver. It's going to mess up the tool a little bit, but doesn't mean we can't play with it. I zero out the stock prices just so that we don't get improper.
Yeah, I was wondering about that. I've seen you do that. What effect does that have?
Well, we're going to mess around with the years. Let me show you. We're going to actually mess around and inject those 2 years. The effect that it would have is if you don't zero it out, it still plots here, and it's not, it plots in 2012 because the software makes it do that.
Okay. Okay.
Now, do I need to show you? I mean, if I put them, back.
No.
Okay.
No,
I just put them out there. I don't want.
Yeah.
I get confused easily enough, so I try to avoid that. So
it's a trick of the trade that I was trying to understand. Okay.
If we go back to Coca-Cola now, we have earnings or sales estimates first. Let's talk about those. 32.3, 36.4. Let's enter those in. So 32.3 and 36.4. And let's go ahead and stop right there and take a look at what does that suggest. And this is actually a great demonstration, Marty, because, pick a number. I like 7. What do you like?
Yeah, I would go with that.
That looks pretty good. I mean, if I'm doing a full-fledged study, equity analysis guide on Coca-Cola, I am very comfortable at this point with the number shown there. Put 7 if you want.
A comment that I've been wondering, go back to that SSG.
Mm-hmm.
I've been wondering why using the Toolkit 6 option of the adding the blue and the green dots in relationship to doing it this way,
mm-hmm.
This takes you out 2 more years then, don't it, by doing it the way you just did it.
Right.
50,000 goes out to 2016 instead of 2014.
You can basically forget the right-hand side of this, the last 2.5 or the last 1.5 columns. We still are only looking at 5 years out. So, in fact, when you see us publish this type of screen capture on Manifest Investing, we stop right here. This is all gone.
Okay.
So we're always looking at that 5-year forecast. Forget the fact that we're not captive to the software. That's one of the advantages that we have. When you look at one of our chronicles, or let's look at sales for Johnson & Johnson, we can put the end of this page anywhere we want, and that's actually an advantage that we have. So anyhow, just to kind of ignore that and watch for how we present the visual analyses on the Manifest Investing forum. You'll see what I mean. We literally would cut the page off right there.
Okay.
All we're really interested in, the difference between the two, I mean, their interpretation is fine. They're plotting the these analyst estimates on their charts. I don't know if they do sales, but they do. Do they do sales and earnings?
They do sales now. They just added sales the last release.
Well, that's to their credit. The difference between our interpretation and theirs is we embed those in the long-term trend, and they're not doing that yet that I know of. So that would be the difference between Toolkit 6 and what we're looking at here.
Right.
And again, we do that because we want to identify impact on that trend. And that's a bigger subject, but we want to identify impact on the long-term trend, and that's one of the ways you do it. So there's the sales. Let's go get the earnings data. And we've got 347 and 374. Let's bring that back here. Go into the data, 347, 374. And just as a footnote, be careful when you're doing this to make sure that the Yahoo numbers are somewhat consistent and the same flavor of earnings. I mean, there are some companies, be particularly mindful of REITs, where you could be looking at earnings here, and Finance Yahoo could have funds from operations. Just be aware that you should be careful with, are we defining things the same way? And in this case, we see, again, a very long-term, very steady trend for earnings at the company. To answer your question now, Marty, what we do now is literally take and calculate these two net profit numbers. We would take the 347 and multiply by the shares outstanding, which let's just call it 2,300. So if I take my calculator and I just do 2,300 times $3.47, all I'm calculating here is this number. So $3.47 times 2,300. I'm getting about, well, 79.81. I would just round that off. Let's call it 7,900. And the 374 times 2,300 shares outstanding would be about 8,600. So all we're calculating there is the net profit from the net earnings times the earnings per share times the shares gives us the net profit. And now if we want to convert this to net margin instead of pre-tax profit margin in section 2A, we'd literally just have to take out the effective taxes, and I just zero out the whole column. So now when we flip to the back side of the stock selection guide, the numbers that are in section 2A are no longer pre-tax profit, they are after-tax profit. We literally put the taxes back, or actually took the taxes back out, and the reason that we do that is so that we can look at the long-term trend on net margin. So here we're looking at, remember that I said that the 24.6 made me a little bit uncomfortable?
Oh, yes.
I'm even more uncomfortable now looking at this. I mean, I would be inclined to perhaps reduce that number in my analysis now. So if we go back to the equity analysis guide, where they've got 24.6, again, going back and looking, I'm seeing, wow, I'm not seeing the higher numbers. I would certainly want to dig in deeper, study deeper, but I'd be more inclined to use a number closer to 22.
Yeah.
If you use 22 there, our projected return, keep your eye on the 15, drops to, again,
wow.
That's a bit of a difference. It just takes a little bit of the edge off the company for sure. But again,
and it changed the whole, even the buy-sell figures that you have there too.
Oh, definitely. Yep.
Different picture altogether.
Mm-hmm. Not dramatically different, but different. So that's how I would take a look at, again, and if you watch how we present on Manifest Investing, we switch this from pre-tax profit margin. This is now net margin. Okay? So again, that's how we do it. And that's really...
That takes... And then now, if you save this, SSG, and then did an update, it's going to wipe out everything that you put in there and bring it back to SSG data. Is that right?
That's correct. And there's no way around that. I do fresh SSGs virtually all the time. I will pull up my most recent one for, I'll save it. I don't actually use the update process online. Everything I do is to pull up an old SSG. I would save this one, and then 3 months from now, pull it back out and I'm not doing any updating online, my numbers would be saved. And what that allows me to do, let's say I'm a stock watcher for Coca-Cola, and this is from 3 months ago. I now come in and look at these current numbers and look for signs of any deterioration or degradation. So I save it just like that, so that 3 months from now I can come back in, or even 6 weeks from now, and see if I'm seeing any deterioration in the analyst forecasts. And I don't use the update process versus the internet for price updates and all that stuff, because I'm not using the rest of the guide at all. I'm using the stuff that's most important.
Fantastic.
All right. So
what a learning lesson.
There you have it. So now what I would do on my own computer, if I'm the stock watcher for Coca-Cola, don't save it as Johnson & Johnson. I would just simply change it to Coca-Cola Eagle.
Yeah.
Date stamp it, and save it. And then I've got it on my desktop, and we're good to go from there.
That certainly is a fantastic tool.
Well,
for your own portfolio and for your club, for everything. It's a wow job, Mark. I thank you.
Well, thanks. All right, so we'll go ahead, and if you're okay with it, Marty, we'll post it so other people can play along.
Yeah, I'm fine. I appreciate it very much.
And, one last thing I should go ahead.
Well, if you don't care, I'd like to share this with my investment clubs as a education session.
Go for it.
Okay. So I've recorded it.
Okay.
All right.
All right. Well, with that, I think we'll go ahead and sign off. Thanks a lot, Marty. Appreciate the question, and hope to get down there to see you in Cincinnati.
Thanks to you, and I hope November works out. I will certainly be in touch.
Let's see what we can do. Thanks, Marty.
Thanks. Bye.
Bye-bye.